Good morning, everyone, and welcome to Tax Issues Relating to Residence and Domicile. Allow me to introduce Amy. Amy's been with us now for nearly a year and settled in well as her role as tax manager. As always, we welcome questions. Please do type these in the Q&A box and we'll do our best to answer these, but also we will send round the answered Q&As along with the recordings within the week. Thank you. Amy, over to you.
Thank you, Sarah. Morning, everyone. As Sarah has said, my name is Amy Manchester. I'm a tax manager at ETC Tax. As Sarah also mentioned, my main focus is on all matters international, hence me leading today's webinar in relation to residence and domicile. And yeah, thanks for joining. Let's get started. So, there is my contact email, which we will be sending around if anybody does have any follow-up questions, just to mention that at the start. So just to start off then, just to give you all a quick introduction in relation to what we will be going through today and how these are important to both you and your client. So first of all, we'll be talking about the statutory residence test and running through how that works and the implications of that. Then we will be looking at split year treatment and double tax treaties, domicile, and also remittance basis. So first of all, just to look at why is residence important? So up until April 2013, tax residence was determined based on a combination of past decisions from the courts and HMRC guidance. After that, the SRT was introduced. Sarah, I'm not sure if you're able to move back a slide. It seems to have moved on. So we'll keep going. In terms of what the implications that will have is, as a UK tax resident, you will be taxable on your worldwide income and gains. As a non-resident, you will only be taxable on any UK work days that you have, along with any UK sourced income, such as rental income. As you can see, there is a big difference between the two, so it is crucial to make sure that the residence is being reviewed correctly. So starting off, just looking at the statutory residence test in a bit more detail, and also known as the SRT, which we'll be calling it today. The SRT has three parts: the automatic overseas tests, the automatic residence tests, and the sufficient ties tests. So, as we mentioned earlier, the residence is reviewed using the statutory residence test, and it is a requirement to review residence each year, as it can change year on year. The way the SRT works is you essentially look at each test in turn, and where an individual meets one of the set of tests, you don't need to move on any further, and they will either be conclusively resident or non-resident. So the automatic overseas tests are the first set of tests we're required to consider. If any of these are met, the individual will be considered a non-UK tax resident for the tax year in question. If none of these tests are met, which we'll come on to look at in a bit more detail shortly, then we move on to look at the automatic residence tests. If any of these are met, the individual will be considered a UK tax resident for the year in question. However, if in a similar fashion to the first test, if none of these are met, we move on to look at the sufficient ties tests. The sufficient ties test will essentially weigh up the number of ties that an individual has to the UK, along with the days that they spend in the UK, in order to determine whether or not the individual is a UK tax resident. The more ties an individual has to the UK, the less days required to trigger residence. And you most commonly find that individuals that spend between 46 and 182 days in the UK will fall within the sufficient ties test. So let's have a look at each of these tests in a bit more detail. So test one, we're looking at the automatic overseas tests. So an individual will be automatically treated as non-UK tax resident for UK tax purposes if They were a tax resident in one or more of the previous 3 UK tax years and are present in the UK for fewer than 16 days in that current tax year. Or they were a non-resident in the UK in any of the previous 3 UK tax years, and they are present in the UK for fewer than 46 days in the current tax year. The final test in the automatic overseas tests are the work abroad test. So broadly, the work abroad condition is met where the individual works abroad for at least 35 hours a week with no significant breaks for the whole tax year and is present in the UK during that tax year on fewer than 91 days and is also working on fewer than 31 of these days. So as you can see, there's 3 different tests within the automatic overseas test. When we talk about being present in the UK, so the first test we're looking at 16 days, the second test we're looking at 46, the third test we're looking at 91 days. We are talking about the midnights that the individual is present in the UK. So for example, if you have an individual arriving in the UK on a Friday morning, leaving on a Sunday evening, although they have spent a full 3 days in the UK, actually in terms of calculating residence and determining the days they have spent in the UK, it would only class as 2 days because they've only been in the UK for 2 midnights. The third test is quite complex. It's complex calculation, which is set out in the legislation. And on one of the next slides, we'll be looking at more information on what is deemed as work for the purpose of the statutory residence test. Just a little bit more information on the third one. So you'll note that no significant breaks are allowed. A significant break would be where the individual has 31 days where there have been no actual work days, not including annual leave or sickness, for example. So, as I mentioned at the start, these are the first set of tests to consider. If an individual meets either of these 3 tests, which you would look at in turn, so the first, the second, and then the third, there's no need to move on any further. And for the tax year in question, the individual will be considered a non-resident. If none of these are met, we need to move on to the next set of tests. So just before moving on, just have a quick look at the definition of working for the purpose of statutory residence test. So it can be either employment or self-employment. The nature of the work is irrelevant. Unpaid voluntary work will not count as work when calculating for the purpose of the full-time work abroad test. Business travel can count as work. However, home to work is excluded. The only exception to this is if the individual is carrying out employment duties during the commute, for example, responding to emails on a laptop, then that time would count as work. And finally, training time will count as time spent working. Brilliant. So next, just to move on and have a look at the automatic residence test. So we've already reviewed the overseas tests. None of them apply to our client for this particular year. We're now moving on to look at the automatic residence tests. So an individual will be automatically treated as a UK tax resident if any of the following 3 are met. And again, we will need to consider them in the order they're provided. So the first test is the day test. And I do find this is the test most people are familiar with, the 183-day test. So again, in terms of a day of presence in the UK, this will be where the individual is in the UK at midnight. So if that individual had 183 midnights in the UK during a tax year, they will be considered an automatic resident for the year in question. The next test is the home test. And to be honest, this is probably the most complex test, in my opinion, anyway, in the SRT. So the home test will apply where an individual has a home in the UK for all or part of the tax year, and they are present in that UK home on at least 30 separate days during the tax year. And whilst they have that UK home, there is a period of 91 consecutive days, of which at least 90 fall within the tax year in question, when either the individual has no home overseas, or if they do have a home overseas, they are present in each of them homes on fewer than 30 separate days in the tax year. So it is a bit wordy and it is quite complex. And it, as I said, it's probably the one I find the most difficult out of all the SRTs, because you've got so many different numbers, so many different rules. But essentially it's looking at whether that individual has a UK home and only a UK home. If not, whether they have an overseas home and how much time they are spending in that overseas home to see whether they meet the home test. So we will move on to have a look at what constitutes a home in a bit more detail on a slide shortly. So the final part of the automatic residence tests is the full-time work test. And again, we'll come on to have a look at this in a bit more detail, but this is essentially where the individual is carrying on full-time work in the UK for a period of at least 365 days. So just having a look at the definition of a home for the purposes of the SRT, just thinking back to the home test. So in HMRC guidance notes, HMRC say, we consider a person's home is a place that a reasonable onlooker with knowledge of the material facts would regard as that person's home. Definition of a home is open to interpretation, to be honest, and that probably doesn't provide us with much guidance. But the property doesn't need to be owned, it can be rented. And a property which the individual never stays in, for example, a holiday home or an investment home, will not class as a home. So that's just padded out a little bit here. So the legislation defines a home as including any building or structure which the individual uses with a degree of permanence or stability. This excludes holiday homes or similar properties which are used for temporary purposes. It is also important to note that definition of a home is different to accommodation. We'll come on to have a look at accommodation when we move on to the sufficient ties test next. But a home does require some degree of permanence or stability and can't be the sort of temporary retreats which we just mentioned, whereas the rules are slightly different for accommodation, basically. Next is to just have a look at the full-time work UK test in a bit more detail. So this was the third test that we were looking at, and an individual will be classed as full-time work in the UK if they work sufficient hours, and HMRC defines sufficient hours as 35 hours a week on average in the UK over a continuous period of 365 days, of part of which fall within the relevant tax year. And during that same 365-day period, there are no significant breaks from work. During that same 365-day period, more than 75% of their working days are carried on in the UK, and the individual has at least one working day in the UK in that tax year. So that 365-day period doesn't have to span the tax year. Actually, what HMRC are saying is only one of them work days will need to fall within the tax year. So you can have a look at sort of different 365-day periods to see whether, so for example, say the individual had 30% of their time working overseas in one of the 365-day periods, but in another of the 365-day periods, they only had the 25% or 20%, which means that they might meet this test. You can have a look at the 365-day period over a different periods in the tax year. So when we talk about work, just a few further points on this. So a work day is where an individual spends 3 hours or more working in the UK. As I'm sure you can tell from this, it is a very complex calculation set out in the legislation. And if you do require any support with calculating this for your clients, please do let us know. Moving on to the final section of the statutory residence test. So this is the sufficient ties test. As I mentioned earlier, this is usually for the individuals that spend between 46 and 182 days in the UK. And that is because they aren't meeting the 183-day test, and they also aren't meeting any of the automatic overseas we'll move on and have a look at this in a bit more detail. So this test considers the number of ties the individual has to the UK and their days of presence in the UK. The more ties an individual has to the UK in a tax year, the fewer days that they can spend in the UK without triggering UK tax residence. There are different limits for arrivers, and an arriver is where an individual hasn't been a UK tax resident in any of the previous 3 tax years, compared with what's classed as a leaver. And a leaver is where an individual has been a UK tax resident in any of the previous 3 tax years. So here is a little table just to summarise the different ties, which we will look at in more detail now. First tie is UK resident family. Second tie, accommodation. Third tie, 40 days or more working in the UK. Next tie is more than 90 days in the UK in either or both of the previous 2 tax years. And then finally, this final tie is only relevant for leavers, but it is the country tie, and it's where the individual has more days in the UK in the tax year than any other days. So we'll just have a look at them ties in a bit more detail. So the first one is the family tie. Family tie is created if either the individual's spouse or civil partner is a tax resident in the UK, or they have a minor child and that child is resident in the UK, and the individual sees that child on at least 61 days in the tax year. So it's worth noting as well, children at boarding school will not count as a family tie, provided that they spend less than 21 days in the UK outside of term time. So there is a bit of so something you need to consider there if any of your clients do have children at boarding school. Spouses and civil partners don't include those separated from, and a partner includes anyone living with the individual as if they were spouses or civil partners. Next tie is the accommodation tie. So an accommodation tie is created if the individual has a place to live in the UK, which is available to be used by them for a continuous period of 91 days. And they spend at least 1 night during the tax year present in that accommodation. Slightly different where the accommodation belongs to a close relative. So you can see here that's a parent, a grandparent, sibling, child, grandchild, for example. The individual would have to spend at least 16 nights present in that accommodation during the tax year, as opposed to just the 1 night if it is personally owned by the individual. There's no requirement for the accommodation to be owned by the individual, so it can be rented accommodation. It would just you need to be sure that is available for that 91 days, continuous period of 91 days. And accommodation can include holiday homes and temporary retreats. Again, it's just important here to be sure that the accommodation is available to the individual for the continuous period of 91 days. If, for example, they rent it out and actually it's only available every month for a month, then actually that test won't be met because it's not available for the continuous period of 91 days. So that's something to think about when looking at the accommodation tie. Next is the work tie. This one's quite straightforward. So work tie is where an individual works for at least 40 days or more in the UK in the tax year. And as we mentioned earlier, a work day is any day on which 3 or more hours of work is carried out. That one's quite straightforward. Presence tie. So a presence tie is where an individual spent more than 90 days in the UK in either of the previous 2 tax years. So a day of presence is where the individual is present at midnight. So as I mentioned earlier with my example of Friday morning to Sunday evening, although that is near enough 3 full days in the UK, actually that will only class as 2 days of presence in the UK. So it is important to make sure that the days are being counted correctly. Final tie is the country tie, and a country tie is created if the individual spends more days in the UK during the tax year than any other single country. This tie only applies to leavers, So leavers will be individuals that have been a UK tax resident in one or more of the previous 3 UK tax years. So now we understand all the ties. Just to move on and have a look at the table so we can clearly see how they play into it and really, and you know, what the ties mean in terms of residence. So as you can see here, the table summarises the days allowed in the UK before triggering UK tax residence. It is slightly different for arrivals and leavers. Residence has what we call an adhesive nature. It's quite difficult to shake off. So for a leaver, it's, I suppose, easier to be a resident than an arriver because the arriver hasn't spent any time hasn't been a UK tax resident in any of the previous 3 tax years. So if we look at an example, so let's pretend an individual spends 70 days in the UK. We will be looking at the 46 to 90 day bracket in the left column. For arrivers, in order to be deemed a resident, they would need to have 4 ties. If they had 3 ties, 2, they'll be, you know, they won't be a UK tax resident. However, for a leaver, it's actually different, and they would only need 3 ties, which is 1 tie less. So that, I suppose, demonstrates it is easier for a leaver to be considered a UK tax resident. So I'm hoping that makes sense. Just to move on and have a look at split year and why it is important. So just to explain what split year treatment is. So where we have an individual that is either arriving in the UK or leaving the UK partway through a tax year, we can look at the split year cases to see whether the tax year can be split into a period of residence and non-residence. So it is mainly relevant for leavers and arrivers, and it was introduced because, you know, people don't just leave the UK at the start of a tax year. They do leave partway through a year, halfway through, 3 months in. So it can be really useful. So it can also be beneficial to prevent any double taxation. So if we say we have a client who is leaving the UK in September, actually the UK tax year, as we know, runs from the 6th of April 1 year through to the following 5th of April. Well, with a September departure date, we can look at whether we can split that tax year into a period of residence up until around the date they depart and a period of non-residence after they leave. So what that will mean for the individual is they'll be taxed as a UK tax resident up until they leave and a non-resident after they leave. Split year can also apply to capital gains, and there's no need to elect for split year to apply. It is automatic, but we do find that we help with a lot of tax returns when reporting the split year, just to make sure that the compensation received by the client is reported correctly and that any reconciliations are performed. Brilliant. So just a little bit of detail around the cases. So there's 3 cases available for taxpayers leaving the UK. We have got case 1, starting to work overseas, case 2, accompanying a partner overseas, and case 3, ceasing to have a home in the UK. There's 5 cases for taxpayers arriving in the UK, so there's a couple more. So where the individual is starting to have a home only in the UK, where the individual is starting full-time work in the UK, where the individual is coming to the UK after ceasing full-time work abroad. So say they've been on an assignment overseas and they're now returning back to the UK now that has ended, returning to the UK with a partner and starting to have a home in the UK. That case 8 is quite similar to case 4. However, you'll notice that case 4 is in relation to having a home only in the UK, and case 8 is just having a home in the UK, so still having the home abroad. So I just wanted to discuss a case study which I have actually dealt with quite recently. So this was for an individual going to work in Dubai, UK domiciled, wanting to be non-resident for UK tax purposes. So the way in which we could help the client is we can help them plan in advance. And so the client was an entrepreneur and he wanted to understand how he can be a UK tax resident for the 23-24 UK tax year, so the upcoming tax year. Entrepreneur had spent a lot, as he's an entrepreneur, he spent a lot of time working overseas, but he hadn't previously looked at his residence status. He always just assumed because his home was here, his family was here, that he would be remaining a UK tax resident. I'd been reading up on the benefits of being a non-resident, and he basically approached us to understand the SRT properly and to find out what that means for him, his types of income, and understand how many days he can spend back in the UK before triggering residence. So because he approached us in advance, especially, we were able to provide tailored advice around the statutory residence test, meaning that he can plan his days in the UK for both work and personal reasons and still qualify for non-residence tax status. So just moving on to look at double tax treaties now. So before we delve into the details, so it is actually possible to not be a tax resident in any country. So each country will have its own what we call domestic legislation for considering residence. For example, the HMRC, UK tax authorities, have the SRT, the statutory residence test. Germany, France, other countries like that potentially have different ways of reviewing residence. But if an individual is spending, say, 2 months in 6 different countries per year, or 3 months in 4 different countries, actually there is a possibility that the individual might not be considered a tax resident anywhere. And it is a case of, I suppose, seeking specialist advice in each country just to make sure that the client is compliant in each of them countries and understands any reporting requirements required by them. So I suppose opposite to that, we've got the fact it is common for taxpayers to be resident in more than one country. So where we find individuals spending 6 months in one country, maybe 6 months in another country, chances are they might be a resident in more than one country. And this is where we can use the treaty to determine the tax residence. So each treaty will have a tiebreaker clause, which will help us allocate residence to one of the countries. So I have just put a snippet here of an example of a treaty, and this is the residence article. So you can see, so I hope it's big enough for you all. You can see here that we're looking at residence, and the tiebreaker clause included is in relation to the first one we will be looking at is where the individual has a permanent home. So just to say ahead of this, sorry, as I mentioned earlier, we would need to look at the domestic rules in each country to determine whether the client is a resident under the country's domestic legislation. If so, and there's a tax treaty in place between the 2 countries, we can then look at whether we can allocate treaty residence per the treaty. So yeah, tiebreaker clause. First thing to look at is a permanent home. If the client obviously has a permanent home in one country and not another, treaty residence would be allocated to that country of the permanent home. If it isn't obvious from the permanent home, we then need to look at centre of vital interests. So this is things such as personal and economic relations, and it would be whichever country the individual has closer ties with. If it's not clear from that, we then need to look at habitual abode. This will be referring to the period of time that the taxpayer spends in each country. Again, if it's not clear from that, and to be honest, very rarely have I seen it get down to this, but it can happen. You would then need to look at the nationality of the individual and see whether the nationality matches either of the countries we're looking at. Finally, if we still can't reach an agreement using nationality, then the countries will actually have to come to a mutual agreement. And I must say, I've actually never seen that in practice. There are obviously quite a few stepping stones there, and you would hope that the client would have met one of them in order to allocate their residence that way. So yeah, it's really helpful, to be honest, being able to do that, because especially with seeing people travel for work purposes, it is quite common to see taxpayers more resident in more than one country. So the treaty can help us allocate treaty residence. just a little bit more about double tax treaties. So as we've just mentioned, can help establish treaty tax residence, can help determine which country gets primary taxing rights on certain types of income. So we can determine which country will tax income in priority to the other country. Foreign tax credits where income is being taxed twice, so it can help eliminate and mitigate double taxation, which is something our clients are always worried about and wanting help with, understandably. And finally, it can allow a country to tax a certain type of income entirely. So as you can see, they are very helpful. So just a little bit more information around statutory residence tests before we move on to look at domicile. I just wanted to mention a few more things really. So first thing, record keeping, hugely important. Where we have a client claiming to be, I suppose, either resident or non-resident, it is really important that that client has sufficient records to back up any claims. For example, timesheets for hours worked, if we're looking at full-time work abroad or full-time work UK test, boarding passes for any flights taken, they can be great evidence of proving, where the client was and backing up that they were where they said they were. Evidence, for example, the home test, we could look at council tax bills, home insurance documents, utility bills, anything really, which is, you would take as evidence that the client is living there, or any of the other ones, for example, backing up hours worked. Something else to mention is just changing plans can result in a change in residence status. So it is crucial to make sure that day count is correct. And a day or two, which didn't go to plan, if they had an extra day in the UK, or they were away for an extra week or something out of the UK, this can have an impact on the reporting required on the return, and it is crucial to ensure that the day count is accurate. And then in a similar fashion, I suppose, residence 1 year could impact a previous year split year claim. So some of the cases, we haven't had time to go through them in detail today, but some of the cases do need the client to either be a resident in the following tax year or a non-resident in the following tax year, depending on whether they are leaving or arriving in the UK. And actually, if you come to look at that following tax year tax return and the residence hasn't gone the way you anticipated, that previous year split year claim can be impacted. So it might be a case of needing to amend the tax return to ensure the reporting is correct and rectify any changes needed on the return. Okay, so just moving on to domicile. So domicile is only relevant when we're looking at whether the individual has any foreign income and gains, which we will come on to talk about in a little bit more detail shortly. So it's a British common law concept, very complicated legal issue determined based on the facts and circumstances of each case. It is definitely a case of weighing up all the factors and making sure that everything is considered. Sadly, there's not one deciding factor, and yeah, we would need to look at everything and all the circumstances of each individual. As I just mentioned, it would only be relevant to the extent the individual has foreign income and gains. Every individual will have one domicile, and unlike residence, it is impossible to have more than one domicile. Just a few more points on this. So the fact that an individual was born in the UK does not mean that they will necessarily be a UK domicile. In simple terms, an individual is normally domiciled in the country in which they have their permanent home. Domicile is distinct from nationality, citizenship, and residence. However, these can have an impact and a bearing on domicile status. Finally, domicile isn't actually recognised by most of the rest of the world. It's a very British concept. So if we think about French, German, US tax systems, they actually all operate by taxing residents in their country, without any regard to the individual's nationality or their domicile. So yeah, they don't look at that at all. It is just a British thing. Okay. So types of domicile, so just looking at these in a bit more detail. So we have 3 types of domicile: domicile of origin, domicile of dependence, and domicile of choice. So as I mentioned, everyone has only one domicile, although the domicile can change during their life. HMRC would be very unlikely to argue with someone saying they have a UK domicile, because something else we'll come on to look at is a remittance basis, which is available to non-UK domiciled individuals, and that can be very favourable for individuals with high levels of overseas income. So yeah, I mean, I've never seen HMRC challenge someone saying they're a UK domicile. The challenge is usually more the other way. So domicile of origin, acquired from your father at birth or mother if your parents aren't married, notoriously difficult to displace, and living outside the UK does not necessarily mean that an individual will have displaced their domicile of origin. Domicile of dependence. So domicile of a child under the age of 16 will follow their legal guardian. After they reach the age of 16, they can legally acquire a new domicile from that age. And domicile of choice. So an individual can acquire a domicile of choice in a particular country. This would be via a combination of physical presence in that country and an intention to permanently settle there. If you do have a UK domicile of origin and you wish to displace that and essentially have a domicile elsewhere, you would need to prove that to HMRC, and you would need to leave the UK permanently settle in the other country, and you would need strong evidence to HMRC to demonstrate that you have abandoned your UK domicile and you will be taking up a UK domicile of choice elsewhere. So things which will be reviewed when looking at domicile of choice are things such as the intentions of the individual, their business interests, their social and family interests, ownership of any property, and the form of any will made. As I mentioned, there's no single criteria. It is a case of having to weigh up everything. It can be very complex, and yeah, please do get in touch if we can provide any support. So moving on to have a look at a case law example. I thought this one was quite interesting. So we have Sir Charles Claw, born in London, 1904. Left the UK in 1977 and acquired a property in Monaco, non-resident in the UK from his departure. Died while on a visit to London 2 years later in 1979. The court established that Sir Charles's father was a UK domiciled, and Sir Charles therefore had a UK domicile of origin. Following his departure, Sir Charles made short regular visits back to the UK and remained a UK citizen. The question was whether he displaced his domicile of origin with the domicile of choice in Monaco in 1979. So when he was coming to look at this, his solicitors actually admitted that he was homesick. His friends testified he'd never settled in Monaco, and HMRC convinced the court that Sir Charles had never settled in Monaco, and so he never lost his UK domicile of origin. So I think this is a great example really of how difficult it can be to displace a UK domicile of origin. You know, he had left the UK, become non-resident, acquired a property overseas, but actually because he hadn't settled there, and that's what the courts believed, they managed to argue that he hadn't lost his UK domicile. So it can be extremely difficult to displace a UK domicile. Another example scenario, just to run through to give you another example. So a non-UK domiciled individual moving to the UK to join his wife. So the ways we can help both you and your client here, really, it's to do with the pre-planning and having to think about the situation in advance of the individual's arrival, both from a domicile and a residence perspective. So pre-residence planning is important as it can help the individual make sure they have the correct bank account structure for any remittance basis claims, help them understand what clean capital is, so implications of remitting any money before you become a UK tax resident. Usually that is tax-free, and that we do find that's quite a big, it's quite an important factor for individuals coming to the UK, because obviously that they will probably need funds in the UK if they're going to be living here and setting up a life here. The client, so if they also anticipate having work days out of the UK, we can help them look at overseas workday relief, help them make sure everything's set up correctly for claiming that, which we'll come on to talk about a little bit in some more detail shortly. Can also help with a domicile review, which will be relevant, especially where the individual is planning to be in the UK long term. And we can have a look at the deemed domicile rules and how these will impact the client further down the line. Finally, it's important to understand the domicile status, because any non-UK assets owned by individuals not domiciled in the UK can be treated as excluded property and outside of the inheritance tax net. So that's just a quick overview really of the things we can do to help and what we find is most important when looking at an individual arriving in the UK. So moving on to look at deemed UK domicile. So from April 2017, the deemed domicile rules changed. Deemed domicile will apply to both long-term residents and formerly domiciled residents. So a long-term resident is a non-UK domiciled individual who has been a UK tax resident in at least 15 out of the preceding 20 UK tax years. So essentially HMRC have introduced this to say, you know, even if you are non-UK domicile, you've actually been in the UK for a substantial amount of years now, we are going to deem you UK domicile. Formerly domiciled residents is slightly different. So these are non-UK domiciled individuals under general law, but they were born in the UK with a domicile of origin and are now again a UK tax resident. This will typically be British individuals who had left the UK, acquired a foreign domicile, but have now returned to the UK to live here again. So what HMRC basically say for people in that case is, well, you were a UK domicile, although that's been displaced, you're now living again in the UK, so we're going to deem you a UK domicile. Long-term residents who are deemed UK domicile as a result of the above will usually lose their deemed domicile status after 6 consecutive years of non-residence in the UK. Once the period of 6 consecutive non-resident tax years has elapsed, the individual will be non-domiciled for the tax year beginning the following 6th of April. A claim for the remittance basis cannot be made as a deemed domicile. However, the remittance basis can still apply automatically. So there is a difference here when looking at the remittance basis. Where an individual has unremitted foreign income in the tax year of £2,000 or less, the remittance basis can apply automatically. What that means is that there's no need to claim it on the tax return. There'll be a specific box to tick if you are claiming it. And actually that will mean the individual remains entitled to the tax-free personal allowance and annual exemption, both of which we will come on to talk about on one of the next slides. So I think this might be the final example scenario, but just to have a look at this one. So this is a long-term non-resident with a UK domicile of origin. So client had been outside the UK since 2005, moved to live with his wife in France and wanted to understand their domicile status as they were potentially going to be moving back to the UK. So as we've seen in the previous example, and as I've already said, it can be very difficult to shake off a UK domicile of origin. The individual would need to have proven whether he has cut all ties with the UK. HMRC would need to review all factors such as where he's spending his time, where his possessions are kept, whether he has any UK assets, where his bank accounts are located, if he's registered to vote in a particular country, where any will has been made. There is a lot of factors to weigh up. That's just a handful. For example, he would also need to prove that his permanent home is now in France. So as we know, you would need to prove all your UK ties have been cut and your permanent home is no longer in the UK. Something else that was quite important with looking at this one was explaining to the individual, if they did become a UK tax resident again, then actually the new deemed domicile rules would impact the individual, and they would be deemed UK domicile from the 6th of April in the tax year which they establish residence again. So there's a lot to think about, especially in the changes of the rules recently. We have found that a number of clients are being impacted by this. So yeah, lots to think about. Moving on to, why does domicile matter? So whether an individual is UK domiciled or not is generally only relevant if they have foreign income or gains during a tax year. If the individual doesn't have any foreign income or gains, the domicile status will have no bearing on their UK income or capital gains tax position. Where an individual is a UK tax resident but non-UK domiciled, they may make a claim to be taxed on the remittance basis, so that UK income is taxed on an arising basis and foreign income is taxed as and when it is remitted to the UK. When we're thinking about what constitutes a remittance, we could be looking at transferring money from an overseas account to a UK bank account, withdrawing cash linked to that overseas account at a UK ATM, spending money in the UK on a credit card linked to that overseas account. So there are various things, and that's just a few examples really. There are quite a few things that would constitute a remittance. And then finally on here, just another huge benefit of claiming the remittance basis is the availability of overseas workday relief. Overseas workday relief is available to remittance basis users for the first 3 years of residence. That would include a split year. So if an individual was arriving in the UK in September of 1 year and they met the split year criteria, they would be able to claim overseas workday relief for that year and the following 2 tax years. Overseas workday relief essentially means that the individual can apportion their earnings based on their UK and overseas duties. So any overseas duties would need, any income relating to overseas duties, would need to be paid and retained overseas. That income would be taxable as and when it is remitted to the UK. Again, overseas workday relief is very complex. There's a lot of conditions involved, but it can be hugely beneficial to any client that has a lot of overseas work days. If they can make sure that they have everything set up correctly, then it can actually help to exclude a large portion of their income from UK tax. Okay, nearly there now. Just a bit more on the remittance basis. So making an election for the remittance basis apply is required essentially unless you have the unremitted foreign income of £2,000, less than £2,000 in the year. And if it's applying automatically, then you will keep your entitlement to the personal allowance and annual exemption. If you are required to claim it, you will lose your entitlement to both of them. Where an election is made, an individual is only taxed on foreign income and gains to the extent that this income is remitted to the UK. So as I was just saying, it really is beneficial for clients that have sort of large amounts of overseas income and are looking to keep that income outside of the scope of UK tax, especially where you have individuals and clients that are only coming to the UK for sort of short term, maybe 3 to 5 years or something. You know, they know they're going to be going back home to that income and they don't really want to have to bring that income into the scope of UK tax. It can be really beneficial, especially in terms of if they have rental income overseas, for example, and that income can be paid and retained overseas, then as long as all the conditions are met and as long as they qualify for remittance basis, then that can be really favourable. So as I mentioned, making a claim through remittance basis will result in the loss of personal allowance and annual exemption. There is a remittance basis charge for long-term users. So a long-term user we would class as where an individual has been a resident for 7 out of the 9 previous tax years. It is £30,000 to claim the remittance basis. And that £30,000 is just an additional tax charge on top of any tax liability. So for example, if the client has £10,000 of pay-as-you-earn to pay, the £30,000 will literally go on top of that and the total will be for £40,000. So basically HMRC make it less favourable for those individuals that continue to claim remittance basis. And what we do find is that it is only still favourable for those individuals that have really high levels of overseas income. That £30,000 moves up to £60,000 where we're looking at 12 tax years of residence out of the preceding 14. Obviously that is a massive figure. So again, we would be looking at individuals that have really, really high levels of overseas income. And then just finally on this slide, claim the remittance basis 1 year doesn't mean that the individual has to claim it every year. They can claim the remittance basis 1 year, file on the arising basis next year. And I will just give you a little bit of information about the arising basis. So final slide is just to discuss really the difference between arising and remittance basis. So arising basis is the tax treatment for UK domiciled individuals. So for the likes of myself, UK domicile, UK resident, and taxable in the UK on my worldwide income. As we mentioned, remittance basis is for non-domiciled individuals, but you don't have to be taxed on the remittance basis as a non-domiciled. It can either apply automatically or you can elect to be taxed on that basis. So sometimes we do find doing comparative calculations really, really good, because if the individual has overseas income they want to exclude, that overseas income is more than £2,000 and they earn below the £100,000 mark, so they still remain entitled to a personal allowance. It's sometimes weighing up whether it's actually worth claiming the remittance basis, forfeiting the personal allowance annual exemption to exclude that overseas income. Sometimes you'll actually find it's more beneficial to just file on the remittance basis, so the standard way, meaning that the overseas income is taxable in the UK and claiming any relevant foreign tax credits. Sometimes that can actually work out better, and it is a case of having to do comparative calculations. So yeah, it will depend on the level of overseas earnings we're looking at. And it will also depend on whether the remittance basis charge is payable. So obviously that £30,000, £60,000 is a big sum of money. And that on top of any tax due can be really big in terms of the value of tax to be paid. So sometimes a rising basis, especially later down the line when the remittance basis charge is applying, can be more beneficial. So that is everything I wanted to discuss around residence and domicile. I'm really hoping that made sense. Just before I move over to hand back to Sarah to discuss the questions that we've had in, I just wanted to mention our upcoming webinars. Sarah, I don't know if you're able to move back a slide. It won't let me move back. The first one is in relation to self-assessment, so devil is in the detail, on the 27th of April. This one will be by Vincent, who handles everything compliance related, and there will be early bird tickets available. Keep an eye out for that. And then the second one is tax considerations for property developers. This will be led by Angela and Keith, who is our VAT Associate Director. Okay, brilliant. So apologies, I've only left 2 minutes for questions. That took longer than I anticipated, but hopefully everyone's found it helpful. Over to you, Sarah.
Oh, thanks for that, Amy. Yeah, we've got quite a few questions. So as mentioned at the beginning, if we don't get around to answering them all now, we will send them a lot out with the slides. So one of the questions is, how do you know when to look at split year? Is it just the people arriving in or leaving the UK?
Yeah, so it's usually relevant for, as you've just said, either individuals coming to or leaving the UK partway through the year. Yeah, that would probably be that. I mean, that's the only time I've ever really looked at it. If you've got people dipping in and out of the UK, so 3 or 4 months in and out, you can look at it, but be very unlikely to qualify for the treatment. So you would need to first of all determine whether the individual has met the residence test. So you only look at split year where an individual is resident for the year. If actually you look at the statutory residence test and the individual is non-resident for the year, then you aren't required to look at split year. Hope that makes sense.
Thank you. What if more than one split year case applies to someone leaving the UK? So how do you decide which case to use?
Yeah, so there are specific priority rules, and the legislation does set out which cases to use in order to the other ones. So case 1 will have priority over case 2 and 3, and case 2 will have priority over case 3. Similarly, for departures, there are ordering rules based on the priorities of them, but this will depend on how many cases apply and which case is going to give the shortest UK part of the year.
And another question is, if a client is working abroad as an employee and remains on UK payroll, do they remain as subject to UK income tax?
So this will depend on their residence status. If they're remaining a UK tax resident, then technically they should remain subject to pay as you earn and still remain taxable in the UK. If they are breaking tax residence, so becoming a non-resident, they can, but are required to remain on UK payroll, then they can apply for an NT, a no tax code from HMRC, to mean that there's no pay as you earn withheld, in hope to prevent any double taxation. But the payroll position from an individual's perspective anyway isn't really that relevant there. Where they're paid doesn't really matter as long as the tax is being taken in the correct jurisdiction.
Okay, there's quite a few questions here, so I'll just run through a couple, and like I said, we'll send out the answers to the rest of the questions and with slides. Deemed domicile, only condition is 15 years. Are there any other conditions?
So in terms of deemed domicile, there's the 2 different types of deemed domicile. There is the formally domiciled residents, which are the individuals, typically the British citizens that have left the UK and are now returning to the UK and will be considered a UK domicile again from when they resume residence, sorry. And the other one is the long-term residence. So that's where you would look at the 15 out of the preceding 20 tax years of being a UK tax resident. And that's where you would meet the conditions to be considered a deemed dom.
Okay, thank you. If somebody has moved to the UK, how long do they have to bring foreign funds into the UK without attracting UK tax?
Yeah, so that's probably going to depend on the specifics of the client, and something we would definitely need to look at is their residence status, because if we just strip it back, the way in which they will be taxed will depend on their residence status. So it would be a case of having a look, reviewing the SRT, seeing whether any split year cases can be applied in order to see whether they will qualify for the split year. And then it would be a case on advising what types of income can be brought to the UK tax-free. It will also depend on whether we're looking at remittance or a rising basis. So yeah, there's a few different things to consider there.
Another question is, can we distinguish between remittance of foreign income rather than capital?
So when filing on the remittance basis, there are specific ordering rules when we do have a remittance. They are very complex, and essentially it's just any foreign income really, which is in receipt of the individual. But there are specific ordering rules. Again, that will be quite specific and depending on the types of income we're looking at, whether as you say, capital or income. But yeah, that is quite specific and something we could take offline and have a look at for you.
Thank you. When you say you will lose personal allowance on remittance basis, are you referring to £2,000 allowance or the £12,570 personal allowance?
Yes, it will be the latter. So the personal allowance, the 12,570. So when actually making a claim for the remittance basis, so where it doesn't apply automatically, when you tick the box on the tax return, that will remove the personal allowance and the annual exemption. So it is a case of, as I mentioned, doing the comparative calculations, because as a result of losing the personal allowance, sometimes it can be more beneficial actually to file on the arising basis. It will depend on the level of overseas income and the level of earnings, because if the client is already earning over £100,000 and actually the personal allowance is being tapered away, then there might not be much of a difference to them if they're going to lose the personal allowance anyway.
I think time just for one more. And what is the importance of keeping or losing your domicile status?
Yeah, so it's to do really with remittance basis. I think for non-domiciled individuals coming into the UK, in terms of income tax, so they can qualify to be taxed on the remittance basis. That is really favourable, obviously, for those clients that have large levels of overseas earnings. Also, there's many more considerations in terms of excluded property, inheritance tax. So as a non-dom, certain non-UK assets can be excluded from the inheritance tax net. So yeah, there's a lot to consider. It can be really complex when looking at it, but I think the main thing really, which we're focused on today anyway, is around claiming the remittance basis. And for those non-domiciled individuals coming into the UK, the availability of having a remittance basis, and then even in terms of overseas workday relief as well. So that is a really favourable relief for non-domiciled individuals using the remittance basis.
Thanks, Amy. We have still got quite a few questions, so what we'll do is we will review these, type them up, and with the answers, send them out along with the recordings within the week. Thank you ever so much for everyone for joining us on this webinar, and we'll hope to see you all again soon on future webinars. Thank you so much.
Thank you, everyone.